A couple of quick questions there. A, do you feel like you're looking at a recession right now? And B, oil prices have been a huge swing factor in all of this. What is your outlook there? What impact could kind of continuing elevated high oil prices have?
Yeah, I don't see recession. All of our customers here and around the world, they know and read all the headlines we do. They've seen no signs that travel is going to abate in any way. In fact, it's quite the opposite.
Yep.
So all the signals suggest to our customers that travel demands are going to be significant. And now with borders opening, and particularly in China, I think we're going to see robust demand. So I don't see recession hampering our industry. Might it hamper others? Yes, but I don't think it's going to hamper ours. We'll all keep our eye on it. And as I said, with the supply chain shortage and order backlogs as far out as they are, by the time you get to 28 or 29, we may have been through 2 recessions. In other words, you can't really make a decision out in 28 or 9 on that basis.
Atlas is going to get their 747 today. When's the president going to get his new one?
They're going to get them when they get them. We're confident in the program. It's been frustrating. We've talked about it. And they're going to love it. They're absolutely going to love them. And anyway, our team's working hard on it. We don't have significant technical challenges. We have, I call them COVID-related issues that cost schedule, and schedule cost Boeing, because it's a fixed price contract. And that is what it is. We signed up, we got to deliver, and that's the way it'll be.
You can't give me a date.
I can't give you a date. I'll let Air Force will give you a date when they're confident in their date.
Okay. Dave, it's been great to talk with you. Thank you so much for inviting us here today. Historic day. The handing over of the final commercial 747. It is an amazing aeroplane, and it has quite literally changed the world. So congratulations on such an amazing program that's had such a huge impact. Thank you very much indeed for inviting us. It's been great to be here.
Appreciate your time, Guy. Thank you.
All right, that of course is Guy Johnson of Bloomberg News out there in Everett, Washington, with the president and CEO of Boeing. We're talking about Dave Calhoun. A couple of headlines coming out, but I will say the new Air Force One, I guess they still have to wait for their plane.
Yeah, the president does. The planes are built. They're being outfitted right now. So
it's a process. It's a long process, as we know.
Yeah, they were originally meant to be sold to another company.
Were they?
Yeah, but now they're going to the U.S. Air Force.
Well, I will say some of the headlines coming, the Boeing CEO talking about autonomy coming to commercial aircraft. That is certainly a trend that we're seeing more broadly when it comes to planes, trains, and automobiles. Boeing plans to begin test flying the truss-braced wing by 2028 and hopes the new plane developed with NASA replaces the 737. Plane development, it takes a while. They're big investments. They take a while to actually get up in the air.
It takes a while, but as Guy made the point many times throughout the program, many times throughout the interview, the 747 only took a handful of years to go from conception actually to being in the air. It was an absolutely different time when it came to aviation and just the engineering marvel. And you just don't see that today.
And then running for 54 years, which is pretty tremendous.
Calhoun said it's going to run for 50 more.
Largely as a cargo plane. One other thing, because it's something that's front and center, and that has to do with the labor market. The Boeing CEO telling our Guy Johnson that the company is hiring, quote, many engineers from Amazon. And we know that when we talk about STEM more broadly, there is a fierce race, it does feel, for workers in that space. Anyway, if you missed any of that interview, be sure to check out Bloomberg.com and catch it all, because it's a big day, a momentous day, if you will, for Boeing.
Well, let's get on over to Charlie Pellet, who's got an update when it comes to the trading day. And I know he's been watching this handoff ceremony.
Indeed, a real big day for aviation. Sad day on the one hand, and also too grateful for the future of that Boeing plane, the 747. We've got the Dow, the S&P, NASDAQ all moving higher right now, with the S&P up 35, gain there of 0.9%. We are holding close to session highs right now. The Dow up 204, up 0.6%. NASDAQ up 133, higher now by 1.2%. Boeing shares, they're flying higher, up 1.3% right now. Boeing says business is booming. CEO Dave Calhoun wrapping up an interview with our Guy Johnson moments ago right here on Bloomberg Radio.
The market right now is as strong as I've ever seen it in my career. It's partly fed by the reopening of the world, the resilient demand for travel around the world, the reopening. China now the latest, and that will be a significant move with respect to market demand.
And again, Boeing shares up by 1.3%. Calhoun making those remarks live here on Bloomberg Radio. 10-year yield 3.51%, with the 2-year 4.20%. Gold up 0.4%, $19.29 the ounce. West Texas Intermediate crude up 0.8%, $78.53 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, gotcha, Charlie. Thank you so much. Well, the Fed's two-day policy meeting, as you know, kicking off today. It's the first of the new year, and we will hear from Jay Powell tomorrow in that press conference. Policymakers widely expected to raise rates by a 0.25 percentage point, slowing from December's 50 basis point increase after 4 straight 75 basis point moves. But the big question is, what words do they take out of that statement, and what comes after this move?
Well, to help us see into the crystal ball, look into the future, very pleased to have back with us Dr. Stephen Skanke, Chief Economic Advisor at Keel Point. He's a former member of the U.S. Treasury and White House National Security Council staff member. He's based in Washington, D.C., joining us today from there via Zoom. Dr. Skanke, good to have you with us. How are you?
I'm great, thanks, and it's great to be with you, Tim and Carol. It's always a fun time, and especially coming into this meeting today and tomorrow. There's so much good news for the Fed to be taking in. Their conversations are likely to be a whole lot different than they were 6 weeks or 12 weeks ago.
There is so much good news, but there's also some concerning news that could lead to potentially rates staying higher for longer. And I point specifically to the jobs market and what we see with just an incredibly resilient jobs market. It's really good, make no mistake, for Americans. It's not so good for the Federal Reserve because they're concerned about a wage price spiral.
Well, that's certainly on their list of concerns. We did get some good news just this morning with the employment cost index coming down again 1% for the fourth quarter, annualizes at 4%. Obviously, it's not where the Fed wants it to be, but it dropped from an annualized rate of 4.8 to 4%. We do expect that the employment gains number coming out on Friday will also be helpful, not negative, but down from where it was even just in December.
So I want to go right to what I think is or could be a really important issue. And if you think about it, and in one of our, I think it was maybe our one of our newsletters that was out this morning, I can't remember which one, but it talked about made in China inflation. And this speaks to our Bloomberg Big Take, which we'll get to a little bit later on. But back in September of 2016, then Fed Chair Janet Yellen mulled the Fed's first interest rate hike in almost a decade. China's economic and market wobbles were among the reasons she ended up staying her hand. How does China, Steve, complicate the situation for Jay?
Well, China is really come back online in far more quickly, I think, than anyone expected. They ended their COVID restraints. They're putting monetary and fiscal stimulus into it. They're standing behind their real estate sector, and so production in China will be helpful. Not that it's been a big negative for inflation, but it certainly will be helpful, and it will be what helps the global economy be less likely to fall into recession. Probably the problem or the biggest challenge for the Fed from China's increased activity is that it's going to be increasing its demand for energy, and that'll just put upward pressure on energy prices. And so well, that's been a positive for inflation coming down. That positive impact is going to go away.
Yeah, I was just looking through our story because I think, concerns about Chinese inflation, essentially what it could do in terms of kicking up inflation and the drag on the global economy, I think it's something like a 1 percentage point difference. I mean, do we need to be worried that it is going to make ultimately the Fed say, you know what, we don't quite know how the China factor and its reopening, how much pickup in momentum we will see and how much drawdown on global commodities and pressure on those prices, that they might just stay higher for longer?
Well, it certainly is going to be on their mind, and that certainly can be a factor in their decision to stay higher for longer. But in some respects, time is really on their side. The core PCE inflation deflator that came out last week, very good news for the Fed. It's annualized over the last 3 months at 2.9%. It's not a 2%, but it's come down significantly from where it was. The tightening and higher interest rates are slowing economic growth, the job vacancy gap, all that's a plus. So the Fed is, I think, likely to increase 25 basis points tomorrow. Most believe that it'll do another 25 basis points in mid-March. And before it has to do anything after that, it'll have a whole lot of information. And many believe, the consensus of economists is that we'll continue to see inflation fall really back to where the Fed wants it to be, notwithstanding the negative influence that higher energy prices coming as a result of China coming back online so strongly could also have.
Okay, so that's a wild card at this point. That's something that we need to keep in mind. And remember, oil supply is not something that the Fed can control. Oil demand, the Fed can control, I guess, to a certain extent when it comes to raising rates and tamping down demand. Dr. Skanke, I want to go back to your point about higher for longer. When do you think, how long do you think the Fed will keep rates this high?
I think they'll keep them this high at least through the end of June. Their rhetoric tomorrow is going to be very much on track with their higher for longer.
That's surprising to hear only to June, though, because in December, the Fed said they had no plans to cut this year.
Well, that's right, and this is part of their forward guidance. They're sounding very hawkish on purpose, notwithstanding what they're seeing internally with the slowing of the economy and some of the other achievements that are coming forth. But rather than having to raise interest rates further and push the economy either into a recession or deeper into a recession, they're trying to strip out some of the euphoria, enthusiasm, exuberance. They look at the S&P up 6% for the year. How is that not a frustration to them? Mm-hmm. And they're trying to use their rhetoric, their forward guidance to tamp that out. But they're also looking at very much a weakening economy. And many now believe, many who thought that it certainly could just bounce around flat and then maybe tip into a recession in second or third quarter, are now seeing that perhaps even in the first quarter, we're going to end up with negative real economic growth.
So, it's an interesting time. And Steve, yesterday we were talking with our Steve Matthews and our team about a story about how Fed is going to, clash with Wall Street once again, because you've got traders expecting a peak policy rate of around 4.9% by May and June, falling to below 4.5% by the December meeting. Further cuts indicated during 2024. However, the latest, dot plot from the central bank forecast showed 17 of 19 officials projecting rates above 5% this year, 2 of them above 5.5%. That's a bit of a gap, a bit of a disconnect. Let's play the arbitrage there, but it's just interesting to see that gap. I mean, obviously the Fed's going to do what it's got to do, but who usually has it right? Are there, traders right about this?
That's a very good question. And to be honest, it's absolutely fascinating when you look at the dot plot. Mm-hmm. And you really have to ask yourself, do they believe what they're saying? Or is this part of the hawkish message they want to send to tamp out this enthusiasm? They're very frustrated with easing in financial markets. They're trying to wring out inflation, and financial markets, Wall Street, are acting as though that job is already finished. In the second half of the year, interest rates are going to decline, and we'll be back to the old game. It'll be the Fed pivot. The Fed absolutely does not want the market to believe that.
That's right. And reservations are up at the pivot bistro.
Right.
Investors are buying into it.
They are.
So what could Jay Powell say tomorrow? What could the Fed communicate tomorrow to really hammer home that this is not what they want to see?
Well, they are going to say they haven't seen anything that tells them they can stop raising interest rates. They're going to talk about higher ongoing increases, plural, in rates that will be required, and the rates will remain at higher levels for some time. He won't let anyone press him to say what that exactly means, but higher rates, higher levels for some time. Their hope, and it really is amazing to watch it. Their hope is that at some point, markets will take a step back and stop this frenzy and belief that the pivot has already happened and that the Fed is happy where inflation is. It's not happy where inflation is, and it'll continue to operate until it gets it down.
Right.
But it's almost as though it doesn't matter so much anymore how much the Fed increases rates or how long they keep them at higher levels. Inflation seems to be in the process of being wrung out as the economy cools, the employment sector is working itself out. And it all gets back to some form of equilibrium.
Right.
The Fed doesn't want to get fooled about. They want to see it happen. So they're not going to trust that it'll happen on its own.
All right, we've got to run. Steve, good to check in with you. Be Wells, Dr. Steve Skanke, Chief Economic Advisor at Keel Point, former U.S. Treasury and White House National Security Council staff member, joining us via Zoom from Washington, D.C. I mean, this is what we're going to see. I mean, you saw how yields kind of pulled in after that employment cost index came in lower than forecast. I mean, this is the predicament that the Fed finds itself in. There are things that are certainly going like they want to. They're seeing a slowdown. It feels like we've peaked in terms of inflation, but you got to make sure you get it right. You don't want to have to stop and then, or maybe you do as the Fed. Maybe if things start to flare up, you start to raise rates again.
I don't know. They're not happy about seeing the S&P 500 up 6% already this year, as Steve said.
That's true. I mean, they keep a watch on a lot of things. All right, we do too, including world and national news. So off to D.C. we go, and Nancy Lyons. Hey, Nance.
Thanks, Carol. President Biden is taking a victory lap. He traveled to New York today, where he touted the success of the bipartisan infrastructure law that's providing money for work to begin on the Gateway Tunnel project connecting New Jersey with Manhattan.
This tunnel opened for business in 1910, 113 years ago, and the structure is literally deteriorating. The roof is leaking, the floor is sinking. Plus, it was badly damaged by Superstorm Sandy. I was the vice president. I came and walked through this tunnel.
Biden says the new tunnel will be critical to easing congestion on one of the major bottlenecks on Amtrak's Northeast Corridor. Well, President Biden is set to meet tomorrow with House Speaker Kevin McCarthy about the federal debt ceiling. And now we're hearing predictions that the White House may be ready to concede to some GOP demands. We got details from Bloomberg's Amy Morris.
The majority of economists in a Bloomberg survey say Democrats will ultimately retreat from their insistence on a clean increase in the debt limit, ending the standoff with little risk of default and a limited effect on the U.S. economy and financial markets. While most economists believe there will be an agreement, they do not agree about how they'll get there. 40% predict Congress will establish a panel to stabilize the long-term fiscal picture. Just under a third believe Republicans will get those spending cuts. In Washington, I'm Amy Morris, Bloomberg Radio.
New York Congressman George Santos says he will not serve on his assigned committees until questions about his qualifications and finances are resolved. He's admitted to embellishing his resume during his campaign, and federal prosecutors are investigating his finances. For the first time after 6 years of declines, the number of births in the U.S. has increased. Almost 3.7 million births were registered in 2021, the most recent tally of numbers. That's a 1% increase from 2020. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It's 2:41 on Wall Street. I'm Charlie Pellet. Stocks holding its session highs. We check the markets all day long at Bloomberg. The Dow, the S&P, NASDAQ very much in the green. S&P right now at 4,056, up 38 points. That is a gain of 1%. We've got the Dow up 219, higher by about 0.7%. NASDAQ up 143, a gain there of 1.3%. 10-year yield 3.51% with the 2-year yielding 4.19%. Spot gold up $6 the ounce, up by about 0.4%, $19.29 the ounce. West Texas Intermediate crude oil up 1.3%, $78.98 a barrel. Broad-based stock market rally, by the way. The Russell 2000 rallying now by 2%. Stocks higher as investors were heartened by signs that labor costs are easing, adding to evidence that inflation is cooling. Investors, of course, looking ahead to tomorrow's Fed decision and that all-important news conference from Fed Chair Jay Powell. Seema Shah is Chief Global Strategist at Principal Global Investors.
We've heard from Powell time and time again that they're very concerned about their historical narrative, and they're very, very concerned, want to learn from their mistakes in the 70s. So what we're saying is that, yes, inflation is going to come down. It's going to come down towards 3%, but it's also going to be accompanied by economic weakness, and that is not going to be enough to convince the Fed until you get into early 2024 when they have clear evidence that inflation isn't going to resurge.
And, of course, as you have come to expect over the years, complete coverage and analysis of the Fed decision. 2 o'clock Wall Street time tomorrow. The news conference, 2:30 Wall Street time. We'll have that for you live on Bloomberg Radio. Earnings, ExxonMobil this morning reporting earnings up by 1.5%. GM surging now by 7.8% after earnings. Caterpillar, though, heading the other direction, down now by 3.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So, Tim, remember how we were all on a buying spree during the pandemic? Well,
yeah, aren't you still waiting for your couch?
Just a few things. Well, the same goes for those in the shipping industry who were looking to invest record profits made during the pandemic. Container lines, man, they went on a buying binge.
Well, now all those new vessels will start arriving, and they've got to be named, just as the global economy is slowing. This story in the upcoming new issue of Bloomberg Business Week on newsstands later this week, already online at Bloomberg.com and on the Bloomberg terminal. With more, we've got Bloomberg Business Week editor Joel Weber and Bloomberg News trade czar Brendan Murray, who joins us on the phone in London. Joel's here in our Interactive Brokers studio. So, Joel, how do you name a ship?
Well, you go to the Midwest and you sort of like throw a dart at a map, and sometimes it lands on a place called Mayview, Missouri. So, Brendan, why is Maersk, who makes a lot of big vessels, some of them bordering on 400 meters even, and these are the style of boat cargo vessels that Tim alluded to that are going to be hopefully coming to oceans near you and helping alleviate
but not too many
trade problems.
Not too many.
But why did Maersk, a Copenhagen-based company, go to Mayview, Missouri to name one of its ships, which that name will be the Mayview Maersk?
That's right. So Maersk is a 120-year-old company, and they're very proud of their history. A guy named Arnold Peter Moeller married a woman whose family was from the tiny town of Mayview, Missouri. This was about 50 miles east of Kansas City. I tried to find a stoplight using Google Earth, and I couldn't find one. That's not to say it's the folks there aren't proud of it. And I'm told there's even a plaque commemorating the fact that they've got one of the world's biggest ships named after the town.
Okay, so names aside, and maybe we can spend a little bit more time with that yet, but Maersk isn't even the biggest buyer, right? Like, who are, MSC is one name that's come up in some Bloomberg Business Week stories lately. It also happens to be a big buyer of ships.
That's right. So this industry, the container shipping industry, made record profits over the past 2 years, basically because we all bought things for our backyards or our home offices. Now that is starting to cool off, but in the meantime, they've all it's dominated by about 10 companies, half in Europe, half in Asia. And MSC, as you mentioned, is the biggest one. It's a sort of fairly low-key company based in Switzerland, owned by an Italian billionaire. and they are going full. They're putting all their cards in the ocean freight game, and they have something like 130 ships on order now at about 150 to 200 million dollars per ship. Somebody do the math for me on that, but it's a couple 20, 30 billion dollars worth of ships they have on order. So yeah, but Maersk on the other hand wants to be more of a door-to-door kind of end-to-end logistics provider. So they only have a couple dozen ships on order compared to probably 10 times the amount or 10 times more that MSC has.
I got to say, I keep thinking of a conversation Tim and I had recently with Mario Cordero, Executive Director at the Port of Long Beach, who talked about shipping containers being canceled. Very different from what we saw in the pandemic. There's no backup. Prices are coming down. It's a very different environment. Are these guys, did they make some wrong bets?
Well, they don't bet on a couple $100 million on a container ship on what's happening over the next 12 to 18 months. These are investments of 20, 30, 40 years sometimes. But this is a very cyclical business. It rises and falls with the economic tides, and we are the economy, the global economy is softening, and all these ships are going to hit the market just exactly the time when they don't need them. Container ships are kind of like hotels, and if they're not filled, they're not making money, and if they're not making money, then the price comes down. So that benefits consumers. We're gonna see and companies like Walmart and IKEA that use a lot of shipping services. They're going to see their rates come down and probably stay down. As our Bloomberg Intelligence logistics analyst said, we're going to see low ocean freight rates well into 2024.
Is it time to talk about the names again? Because
you can talk about the names again.
Why not talk about the names again? Brendan, I'm curious, since you did some dogged reporting here, what did you learn about names that was, as somebody who follows this stuff so closely, what was the big reveal for you in the naming of how we get these, vessels that sometimes become iconic in pop culture, in the case of, like, say, the Ever Given?
Right. If you bring up the Ever Given, so Evergreen Marine is a Taiwanese company, and they like consistency. They like putting ever in front of the name of their ships. So they've got dozens and dozens of ships. That's the Ever Burley. I think there was one. The Ever
Superb. Yeah.
Exactly. Just any noun. Fill in the blank and put ever in front of it, and that's how they name their ships. Other companies, it's some source of corporate pride. I mean, the MSC said that they named theirs after family members of employees. So maybe it's kind of a motivational thing. You have a good year, and you get a ship named after your kid or something.
Well, Brendan, you've done so much reporting on this. Have any companies come to you and said, we want to name this one after the trade czar at Bloomberg?
Well, I did lobby for that with Maersk, and the public relations guy who I talked to said, you got to get in line behind me, because I won't say his name, but he's kind of quietly wants one named after him.
I got to say, the Ever Brendan has a kind of nice ring to it.
It does. Don't get stuck in the Suez, though.
I agree. Exactly. Well, there's 900 ships coming over the next 3 or 4 years, and so you got to figure one of those could be named after one of us, maybe.
We didn't come back to Mayview, Missouri. Why Mayview again?
So Mayview stuck out to me because number one, because I'm from St. Louis, and I wanted to know how did this tiny little town, literally, like I said, there aren't any stoplights. It's not even a suburb of Kansas City. It's kind of just an old farming community that has basically had 200 or 300 residents for as long as I could see the census data go back, and it meant something to the history of the company. I spoke to the historian. Maersk has an in-house historian, and he said that there are family members, descendants of the founder who still work for the company, and that's just been the tradition that they try to. Keep that tradition going.
Arnold Peter Moeller was married in Mayview. Go ahead. Go figure.
Evermurray works too.
Evermurray. It does. Ever Weber?
I mean, why not? I'll take that.
All right, Joel and Brendan. Thank you.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 2:53 on Wall Street. General Motors expects its earnings momentum to grow this year on higher production volumes. Paul Jacobson is CFO at GM, and in an interview this morning on Bloomberg Radio, he was asked about yesterday's price cut announcement from Ford for some of its EVs.
You know, as we look at the business, competition is no stranger to us. We've been in the business for over 100 years, and I think the team is really good at competing. And where we see consumer demand for our vehicles at our price points is really strong. We just need to make sure we get production up to be able to meet that demand.
And Boeing shares up now are actually shares of General Motors up by 7.8%. Boeing, though, is bidding farewell to the Queen of the Skies with the final 747. CEO Dave Calhoun spoke earlier this hour with Bloomberg Radio about delivery of the Queen of the Skies to cargo carrier Atlas Air.
It's an amazing feeling. This is the symbol of innovation in our country, for our company. It's been that way for a very long period of time, over 50 years, in fact. This airplane will fly for another 50 years. So it's not as if we're putting it to bed. It's simply we're producing our last.
And Boeing shares up now by 1.5%. Lots of earnings this morning. ExxonMobil, its shares are up by 1.9%. And Caterpillar, after earnings, they are trading lower, down now by 3.5%. Those are some of the company stories we're following this hour. I'm Charlie Pellet. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week. Let's get a check on the latest world and national news with Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. President Biden and House Speaker Kevin McCarthy will be sitting down together at the White House tomorrow to discuss raising the federal debt limit. And administration officials say the president will ask McCarthy for details on what budget cuts his party is demanding in order to reach a deal on the debt limit. President Biden will release his annual budget on March 9th, and he'll be asking McCarthy when he would be doing the same. Well, as House Republicans look for ways to rein in government spending, it should not be immune to cuts. Bloomberg's Nathan Hager has more from Washington.
Ken Calvert is the new chairman of the House Appropriations Defense Subcommittee. He tells Bloomberg Government the Pentagon's $817 billion budget should grow 3 to 5% over inflation, but he also wants to look at how the Defense Department operates. Calvert says he'll focus on the Pentagon's payroll and inventory, how it buys weapons, and how to reduce its civilian workforce, mostly through attrition. In Calvert's words, when it comes to defense spending, there's a lot of low-hanging fruit out there. In Washington, I'm Nathan Hager, Bloomberg Radio.
Republican Congressman George Santos of New York says he is temporarily stepping down from his 2 congressional committees. He shared the news with his GOP colleagues following a host of ethics issues. His decision also comes a day after he met with House Speaker Kevin McCarthy. He's facing multiple investigations by prosecutors over his personal and campaign finances and his lies about his resume and family background. More than 1,300 flights have already been canceled today as winter weather hits parts of the country. FlightAware says the biggest trouble spots include the airport in Austin, Texas, and both airports in Dallas. At least 1/4 of flights originating from or heading to those airports have been canceled so far today. Other areas having issues include Nashville and Denver. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carol and Tim.
Thank you so much for that update, Nancy. Really appreciate it. Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds that 70 to 80% of small businesses are good candidates for taking the employee retention credit. Don't bother trying to navigate hundreds of pages of tax code to learn if your business qualifies for ERC assistance. Let the tax professionals at Innovation Refunds do the work and help you secure the future you want for your business. Learn more at getrefunds.com.
All right, folks, in just a few minutes, we're going to head over to our TV colleagues, talk a little bit about the trade today. This as equities are pretty much at their highs of this session. We know that yields have backed off following some of this morning's economic data on the labor market, in particular, wage costs seeming to diminish or not grow as much as they've been growing. So we'll talk about that in just a moment. In the meantime, we've got a story about New York City to face the first deep chill of 2023 as snow drought may come to an end. Winter will take its first bite of New York City since Christmas as a lumbering low-pressure system drives down from the Hudson Bay in Canada Canada?
Yeah, it's a place.
In Canada, and blankets the East Coast in frigid air.
Just in time for the weekend, Carol. Great news. Okay. Temperatures are going to drop to 6 degrees Fahrenheit. That's negative 14 Celsius. Friday into Saturday. In
Might get
Central
some
Park
light snow
before
then,
rebounding to about 20 later in the day. That's according to the National Weather Service. Yeah, we might actually, get some snow for the first time in a year.
It's different because it's felt like almost spring-like. In the meantime, another story out there about New York is buying an unusually large amount of gasoline and diesel from India, a country that has become a top outlet for sanctioned Russian oil. So essentially, New York City is gorging on fuel made from illicit Russian oil. So just FYI, folks.
You ready for this weather?
I don't know. It has been so weird.
It's so weird. I was like, this is so New York Centric.
I like a
but
cold
walking
winter.
home yesterday, I was like sweating. Should be wearing spring coats right now. It's January.
I know. It's why I'm layering. All right, guys. Right now, we're going to head over to our TV colleagues, talk about the markets. Bloomberg's countdown to the close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading session. Romaine Bostic, Katie Greifeld, joined right now by our colleagues Carol Masser and Tim Stenovic. We welcome to our audiences. What's going on? I'm sorry.
Where you been?
I
We've
don't know.
missed you.
Carol, look, Carol.
I mean, I haven't been here either. But
I take after Carol.
I miss you too,
we all
Katie,
know
but I
Carol
saw
only
you in
works
the
3
makeup
days a
room.
week. And I said, if Carol can get away with it, surely I can get away with it.
It's not a bad schedule, is it?
Yeah,
4
it's
days a
kinda
week. We
nice.
should all
I might
try
have to
it.
get used
we
to
all
this.
have to recharge. It's so important.
Interesting day here. I mean, I came back here. Of course, we know the Fed started their meeting. A lot of people, I guess, are pretty excited in the markets right now that they think they know exactly what the Fed's going to do, and more importantly, what the Fed maybe won't do, which is to continue hiking rates.
Yeah, good luck with that thinking.
Yeah.
All right, having said that, let's find some outperformance, as I like to do. Huh? What? What?
I just missed you.
Okay, well, we missed you too. Home builders, definitely some outperformance there. That index, if you look at the S&P Composite Home Building Index, it's up about 4.3%, and that is thanks to some earnings from both NVR and Pulte. Both fourth quarter earnings beat. Check out NVR, up about 4.7%. Pulte is up almost 8.7%. Toll, they report later in February. They're up about 4.5%. This index, though, this group overall, it's up more than 40% since late October, Tim.
All right, we are in the midst of earnings season. It's not just the Fed that is happening today and tomorrow. So I'm going to take a look at a handful of companies that reported earlier today. General Motors shares surging up by 7.74%. They beat on the top line, the bottom line, and its forecast for adjusted earnings before interest and taxes came in above analyst estimates. Oh, and that price war between Ford and Tesla, they're not worried about it. UPS shares higher by 4.5% right now. The fourth quarter revenue missed forecast, though. U.S. package sales rose. The company to give a full-year outlook that largely met analyst estimates. McDonald's shares down by 1.6% after its operating margin for the fourth quarter missed the consensus estimate. The forecast for the measure also trailed.
All right, we talk about the broader markets here on this January 31st, last trading day, of course, of the month. A great start to the year, and it looks like today is going to be a great end to the month. The S&P 500 up about 1% here. The NASDAQ up more than 1% as well. The Russell 2000 up about 2%, and Dow Transport's absolutely on fire here on the day. All of the major indices now are posting pretty solid gains on a monthly basis, with the NASDAQ probably the most relevant outperformer, up 10% in the month of January.
That's unbelievable.
It is unbelievable. But you know what else is unbelievable? You have 10 of 11 sectors higher right now. A real risk-on vibe. You can see consumer discretionary is up at the top, up by 2%. A lot of that is the automakers. Tim mentioned those earnings that we got out of GM. That is helping boost the group as a whole. You also have materials, real estate getting in on the action as well. And you look at what is not doing too well. It's utilities. That's the laggard, but just barely. It's only down about 0.1%, Romaine.
All right, 0.1%. We talk about some of the individual movers here. Going to get some earnings after the bell. Keep an eye, of course, on AMD and Snap. Obviously, two completely different companies, but both could offer some interesting commentary here on where we stand in the broader economic sphere, whether it's chip demand, whether it's advertising. surprising in the case of Snap. But we also got a couple of earnings this morning that also showed a bit of a divergence as well. Caterpillar shares down about 4% here on the day. This is largely because of higher costs that Caterpillar is having to take on to make its machines and softer demand in China, one of its most important markets. Meanwhile, you have International Paper moving the opposite direction, up 10% here on the day, providing what I think is really the headline of the day. Cardboard box comeback points to early signs of consumer revival. You take a look at the humble cardboard box. I know you all sort of overlook it. Well,
it's a great
important.
indicator,
You know,
right?
my father used to sell, my father had a whole business. He sell cardboard boxes and paper bags. And, probably the two most boring businesses out there, but everybody needs them. International Paper benefiting from that need right now. All right, that brings us back to the Fed, guys. Of course, that meeting started today. The big decision tomorrow. They're looking closely, of course, at inflation and the direction that it's going. The latest data point that we get shows it's going in the right direction. The employment cost index, guys, moderating below expectations. That's a good sign. It shows things maybe are rewriting, at least over the last few months.
A lot of indicators for the Fed to play with. You've got cardboard boxes, you've got wage inflation, and you also have margin pressure. This is something our Gina Martin-Adams has talked a lot about as we go through those corporate earnings, whether or not these companies are able to manage costs. That's why we've seen layoffs by many companies as well. Well, another person who's watching profit margins is Goldman Sachs Chief U.S. Equity Strategist Dave Costin. He weighed in with our Bloomberg team earlier today. Check it out.
We're still looking at a number of months of headwinds in terms of profits. And one of the reasons for that is that the margins are declining. And so therefore, the best that you get is flat earnings year over year for 2023 compared with 2022.
And that is Dave Costin over at Goldman Sachs, Chief U.S. Equity Strategist. And he says because of the concern over declining U.S. profit margins, he likes European and Asian stocks better. He thinks that's a better buy, Tim, for investors right now.
I think it also just adds to the conversation that we've been having over the last few days about the rally that we've seen this month. And to what extent this is kind of the opposite of what the Fed wants to see. Romaine, we spoke with Steve Skanke over at Keel Point, former Treasury official, and he was saying that if you're the Federal Reserve and you're seeing the S&P 500 up, 6% so far this month, that's not what you want to see if you're Jay Powell.
Well, it's not what you want to see. Frankly, I think he's lost that battle. I mean, I know we talk a lot about this idea of not fighting the Fed, but it's very clear what the market's expectations are. And it's also very clear that the market isn't sort of making these bets based on what they're hearing out of the Fed or what they think the Fed is going to do specifically. They're looking at the first order effect, which is what the economic data is showing them. And I think it has been pretty clear. Whether you buy the idea that the Fed will pause, I don't think you cannot push back on the idea that the trend has been moving in the direction that the Fed wants it to see.
Well, that all gets us to 2:30 p.m. tomorrow and what kind of Jerome Powell we're going to get, whether he does push back against the easing that we've seen in financial conditions. And even if he does the market listen at that point, or do they consider to continue to say inflation's easing?
How does he take into account, too, some of the big macro things? How does he take into account the bounce back in stocks? What's going on with very easy financial market conditions? And how does he take into the Bloomberg Big Take today in terms of the impact of China reopening and their demand and how that plays into the global inflationary picture? There's lots for him, a lot of questions for him to answer.
Yeah, the last thing I'll say is, we also get jobs numbers for this month coming on Friday, Romaine. And if we see, 160,000 new jobs added, that also shows that, things are coming down, but not maybe to the level that the Fed wants to see when it comes to jobs.
And don't forget, even before we get to that, we'll get the ADP and JOLTS data, so it'll give us a little bit of a peek here into maybe what that Friday report shows here. But again, guys, we cover this day to day. We've seen the data over the last couple of months here. Like I said, we're nowhere near normal, or at least what the Fed would consider normal, but we're certainly trending in that direction.
And don't forget, we have earnings to get to before we get to any of that. We got Snap, we got AMD. We're going to have a lot of fun.
Mondelez, so is Oreos. They didn't match the dating. That's pretty resilient. Snap, which I don't know. Is that still
I haven't used that since college.
Do you think Snap, is Snap's commentary important about about the global advertising market?
Yeah,
because in the past it has sent, it has sent the whole sector lower.
I think the teens still use Snap, so I would imagine that's important.
All I know is I'm hungry.
They do.
Let's bring out the Oreos right now.
That's a hard no.
All right, good to have you back, Romaine. All right, we're going to come back, though, in less than an hour's time.
Hey, Tim, it's great to see you.
Oh, do you know I do have feelings. All right, we'll be back in less than an hour's time. We're going to count you down to the close, and we're also going to bring you a bunch of earnings. We'll see you at 4 p.m. Wall Street. The Fed meeting, of course, tomorrow, and how does a lot of different things that are going on, how does the Fed weigh with what's going on with the financial markets, the rally that we've seen in stocks, easing of financial market conditions, you know, against some of the weaker data points, but inflation coming down but still out there? And then how does China ultimately kind of impact the bigger picture?
It's absolutely a wild card here. Well, China's reopening is set to provide a welcome boost to global growth. It'll offset weakness in Europe, a looming recession in the U.S., but there's a catch, and that's it could send global inflation higher.
Totally.
Right. It's all about today's big take. It's a most read Carol on the Bloomberg terminal.
All right, so let's get to it. We've got one of the writers of the story, Bloomberg Economics chief economist, Tom Orlik. He joins us via Zoom from Washington, D.C. Tom, we've been so eager to get to this story. I think it's one of the big factors of 2023, but we'll see how it plays out. It's kind of a mixed blessing, right, this China reopening?
Yeah, I think that's completely right, Carol. On the one hand, you've got Europe limping into 2023, hobbled by the after effects of the energy crisis. You've got the US very likely heading into recession in the second half of this year, dragged down by the impact of Fed tightening. So China reopening, seen from that perspective, is a welcome boost to global demand. We looked at the numbers, and based on our calculations, China reopening adds about $500 billion to global demand. That's the equivalent of adding an entire Nigeria to the global economy. But with that extra demand comes the catch, right? China reopening, that's going to drive demand for oil. It's going to drive demand for agricultural commodities. What happens when demand for commodities goes up? Well, prices go up as well. So the risk as China reopens is that there's an additional boost to inflation at just the moment when Powell and Lagarde and Bailey hope it's finally getting under control.
It's pretty incredible, Tom. You and the team behind the big take today write that Air New Zealand is adding flights to Shanghai. Shares in luxury retailer LVMH, Moet Hennessy, Louis Vuitton, SC have rallied. Swatch Group said it could hit record sales. This all as China rebounds. The problem, though, as you point out, is that we could also see prices rise as a result. Copper prices have gone above $9,000 a ton. Chinese oil consumption is forecast to hit a record this year. Bring it back to the Federal Reserve and how Jay Powell and co. meeting today for the first day of a two-day policy meeting, how they take that into account and how they even can take that into account given it's out of their control.
Yeah, so it's a tough one. The challenge, of course, is that China reopening is an unknown quantity, right? We can put an estimate on it, but until we see the numbers, it's hard to size it with a very high degree of precision. And then the transition from there to what that means for oil prices and what that then means for the thing which the Federal Reserve really cares about, inflation in the United States, well, there's further uncertainties there as well. So what we've done is we've taken our forecasts for China growth and we've plugged them into a model of the global economy, which has China, it has energy prices, it has CPI in the US, Euro area, UK, and elsewhere. And we've used that to make a kind of best estimate of what China reopening means for inflation here in the United States. And what that exercise is telling us is that China reopening could add around 0.6, 0.7 percentage points to US inflation. Now, in the context of a US CPI, which only a few months ago was as high as 9%, 0.6, 0.7% doesn't seem like that much. But if you remember that Powell and co. are really laser focused on getting price changes back to that 2% target, actually 0.6, 0.7% is rather a lot. It's possible, and this is one of the big takeaways from our big take, that China reopening could keep the Fed hiking into the second quarter, frustrate market expectations, pause, and then rate cuts at the back end of the year.
Yeah, it's funny. Was it you guys who, is it in your story that you talked about something Janet Yellen did? Was it back in 2016? Where she too, I think, was looking at China and it impacted, I think, how she thought about whether or not to, I think it was raise rates. at the time. So it's not like we're, I mean, these things happen, right? The Fed, as much as we say, Tom, that they are, they've got a dual mandate, they've got to look at everything when they make decisions.
Yeah, I think that's completely right, Carol. I mean, structurally, over the last 20 years, the China shock for the US has been deflationary, right? The sudden influx of all those cheap made-in-China products have done the Fed a favor. They've helped keep wages and prices under control here in America. But at particular moments, there's something which happens in China which can really throw the US economy, US financial markets, and Fed policy out of whack. You mentioned one of them back in 2015, 2016, where we had that China equity market crash, that China yuan devaluation. It was a real panic moment for the markets, and it prevented the Fed from delivering the hikes which Yellen said they were going to deliver. In 2023, it could be that China results in pressure in the opposite direction. China reopening, big boost to global energy demand, oil prices rise. It could be that keeps inflation high enough to keep the Fed hiking longer than the markets expect.
Tom, is there anything that could derail China's reopening?
Right, because it's so easy to know. We know China just goes in a straight line, right?
Well, that's the thing. I mean, I think, if we were talking 6 months ago, we'd be talking about the COVID zero policy. 3 months ago, we'd be talking about COVID zero going indefinitely. This was a big surprise to a lot of observers. And you spent a lot of time in China.
I think that's completely right. I mean, the base expectation for 2023 is that China rebounds really strongly, right? We're talking about 1.4 billion people. Last year, they were living under lockdown or fear of lockdown. This year, those lockdowns are over. We already see them traveling, going to see family and friends for Chinese New Year, visiting tourist sites, visiting restaurants, visiting the cinema. The base expectation is we go from 3% growth to 5.8% growth in 2023. But if you step back from the detail, what's actually going on is that we've gone from a Chinese economy which is really predictable to a Chinese economy which is pretty unpredictable, right? The COVID zero reopening happened quicker than we expected. There's more property stimulus in the economy than we expected. Xi Jinping's trying to be a bit friendlier with Joe Biden and the United States than he was a few months ago. So right now, all of these things are moving in a positive direction for the economy. But as you suggest, there's just a lot more uncertainty, a lot more volatility there. So it's difficult to make calls about China, even on a one-year trajectory, with a high degree of certainty.
Tom, I know it is difficult to predict. So what's more likely, that we have, China back online and their increased demand plays into global growth on the upside, or is there, more likely a chance that we'll get another wave of COVID infections and it starts to shut down the economy again, shut down factories, and that plays into constraints on global supply chains? And just got about a minute or so.
So our expectation is that by the time we get to the end of the first quarter, and certainly by the time we get into the second quarter, it's going to be the China back online, China driving global demand, China boosting global inflation story. But for the next few weeks, Carol, I think it's going to be challenging and messy. Everyone in China just got on a train to see their friends and relatives. That's a moment where you can have a lot of people meeting, a lot of opportunities for the virus to spread. It's possible that the rest of the first quarter is going to see another wave of COVID infections. It's possible things in China will get worse again before they get better.
So, Tom, just in the last 20 seconds we have with you, what is one indicator for us to watch in that vein?
So the big thing which got crushed in China during COVID was services consumption. People didn't want to go to the restaurant. They didn't want to go to hang out with their friends. The January data is already showing services booming back. We'll be keeping a close eye on that heading into the rest of the year.
What a great story, and what an important one, certainly for 2023. Tom Orlik, thank you, Chief Economist at Bloomberg Economics, via Zoom from Washington, D.C. Check him out on Twitter at Tom Orlik, O-R-L-I-K. Right now, we've got stocks just rolling over, just off their highs of the session. A rally underway in some of those big tech names, up 1.1% on the NASDAQ. Carol Massar, Jim Stanovic, Bloomberg Business Week. This is Bloomberg Radio.
Connection lost.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. I'm Charlie Pella. We check the markets all day long at Bloomberg. The Dow, the S&P, NASDAQ, all advancing, but we are off session highs. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks with a bid today, with the Dow currently up 177 points. S&P's gained 33, and NASDAQ is up by 125. The U.S. 10-year yield at 3.52%. Gold is up 6, oil trading in the green, and Bitcoin is higher by 1.8%. Among the main 11 S&P sectors, only utilities were in the red, and leaders to the upside in the Dow, Home Depot, and UNH, while Caterpillar fell 3.8% after earnings and led to the downside. Also after earnings, International Paper rose 10%, GM climbed 8%, and UPS gained 4.5%. In other news, PayPal to lay off 7% of its employees. And wrapping things up, some of the names reporting after the bell tonight include Amgen, Stryker, EA, and AMD. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill, and to hear live breaking news over your Bloomberg. Type Squawk, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. It is time for Plugged In, your weekly look at EVs. And I got to say, Tim, lots happening in the world, always, when it comes to electric vehicles. GM investing $650 million in developing the largest U.S. lithium deposit. And that's really a move to ramp up its efforts to secure supplies of the key metal used in electric vehicle batteries. I mean, it is all about getting those raw materials and components in order to be able to meet demand.
And speaking of demand and EVs, GM CEO Mary Barra dismissing concerns about those price cuts after Tesla and Ford cut their EV sticker prices. Look at shares of GM today, up significantly after reporting results. Let's break it all down with Bloomberg Technology co-host Ed Ludlow, who's in the Bloomberg 960 studio in San Francisco. And I want to start with the $650 million investment that GM is going to make, the largest U.S. lithium deposit. So
yeah, it's a big headline.
It is a big headline, but take us into the details of this.
Is it just a headline? Is that what you're saying?
What's the story behind the story here?
I mean, the devil's in the detail. This is for lithium supply starting from 2026, so a few years away from now. But, you know, it's all part of the wider story about concern for all of these players, Tesla being the pure play market incumbent, GM and Ford being the legacy US names transitioning to EV, making sure that they have access in their supply chains to the raw materials for battery cells, right? As they ramp up the volume of EVs they produce, they need more battery cells, and therefore they need more access to the metals that go into them. And, you know, in this case, it's lithium. It's a partnership with Lithium Americas Corp. It's about a mine in Nevada, specifically the Thacker Pass mine. And, you know, I think that, you know, it meets GM's ambition, right? Because this is a company that, you know, is aiming to build 1 million EVs a year eventually, and they need to make sure they've got the raw materials to do that.
Do we have enough lithium to do what we need to do to turn over everybody to an
Ooh,
EV?
trick question. That is a trick question.
I'm curious
Carmen.
what the conversations you have around this.
Well, do you know why it's a trick question? And it's because it's not about necessarily how much lithium we have available to us, but also where it's coming from. Because remember, the whole point of the Inflation Reduction Act, which provides for a federal credit, a consumer incentive, being eligible for that incentive long-term is dependent on where you source your raw materials on. In lithium's case in particular, China is such a massive player, and the whole point of the IRA is to make America's supply chain more competitive. So it's not just about how much lithium there is on the planet, it's about where it's coming from and making the US more competitive. And again, this announcement that GM made Tuesday is for a mine in Nevada. So that would very much mean that any battery packs with lithium from that mine were eligible going forward for that IRA credit.
But also brings us back to the question about making different batteries, or batteries that have different materials in them, Ed. And are you betting on a component that's guaranteed to be used for the next X number of years?
Yeah, I mean, you have to look at the work that Tesla's done, right, around changing the cell chemistry. Lithium is one metal that is prominent in lithium-ion batteries, right? But also cobalt and nickel are important. You can use different cell compositions and cell chemistries to boost the proportion of one to the other. The end goal is to make sure that the battery or cell, and therefore pack, has the greatest energy density. How much energy can you squeeze into that little cylinder and into that battery pack? That is the equation from an economics perspective of what they're trying to achieve. How expensively or cheaply, conversely, you source your metals has a direct impact on that.
So I just feel like, you know, it's interesting, Ed. I was looking to put together some gainers for when we do our cross-platform, you know, market close here today. Yeah. And it's interesting. You've got Tesla continuing, you know, to move higher this year. Again, rallying. Rivian, I believe, was also among the top gainers in the NASDAQ 100. I just wanted to do a last check here. You know, we're seeing a lot of momentum into that space. We know that there's a bit of a pricing war going on, although GM saying and Mary Barra saying we don't necessarily need to play in that price war. So what are the bigger, broader trends that are going on here when it comes to the EV space?
I mean, I would love to tell you that the market's dynamics driving the market is about kind of the love back in love with EVs. You have to remember, these are also some of the most downtrodden stocks there are out there. Rivian and Lucid, the two worst performers on the NASDAQ 100 in 2022. Tesla had its worst year, I think on record, I was just checking my Bloomberg terminal, in 2022, right, a 65% decline. And so you see a lot of participants in the market look at how valuations have come down and say, yeah, now's a good time to buy. The other side of the coin is that Tesla's earnings were great. You know, they showed that using the lever of price cuts does induce demand. And Elon Musk talked about in the first early weeks of January of this year, the demand for their vehicles was twice what they're able to produce in that snapshot moment. So there is excitement about what's possible, but still nervousness broadly about demand tapering off this year.
Were you surprised, Ed, to hear GM CEO Mary Barra dismiss concerns about price cuts, given that Tesla and Ford seem to be in this, the beginnings of a price war?
Yes, I mean, the general consensus across sell-side analysts, at least, was that Tesla cutting its prices, in the words of RBC, would have a cascading effect. So, you know, Ford went next. There was suspicion, actually, that we'll see the European automakers follow suit. GM's currently bucking that trend. It's interesting because they had earnings, right, and the numbers was very strong, particularly how bullish their outlook for earnings this year would be. The EBIT forecast in particular, or earnings per share of $6 to $7 for the full year. But you have to remember that that is held up on a pillar of sustained demand for their expensive gas vehicles while they transition to electric vehicles. The price cut comments were interesting, though. They basically seem to be saying, we're not going to adjust the prices of our electric vehicles for now. But remember, GM has done what many automakers do. First come to market with a very expensive EV, and then models that are more mass market, more affordable, those are still a little way away from mass production. So that's part of the equation too.
Do we ever think about that in terms of the raw materials that were going or that are needed in order to make all of these electric vehicles? I mean, I know the discussion's been out there, but Ed, I wonder if there's more momentum that we're just kind of trading a fixed commodity with limitations on the amount that are out there, meaning fossil fuels, just for another basket of raw materials that are fixed as well.
I appreciate the debate. I mean, at the end of the day, that fundamentally what you have is a lot of demand, which is in the form of many automakers with plans to ramp their output of electric vehicles, trying to latch on to what is a relatively finite, immediately available source of supply. You know, and it's no surprise that we saw GM make this announcement on lithium with Lithium Americas on Tuesday. Tesla's done very similar things in vertically integrating its supply chain, right? In other words, cut out the middleman, go direct to the source and use that to make your cells. The thing is that those legacy automakers, GM and Ford, they're future-proofing, right? So GM forecasts making 400,000 EVs from the start of last year through to the middle of next year. Long term, their aim is to reach millions of units, but they're not quite there yet. Ford is ramping up the Mach-E production from around 78,000 units last year to 130,000 this year. But long term, its ambitions are much greater, and it's that long term that they're trying to secure that supply for at the moment.
As we spoke about yesterday, though, Ed, one of the challenges here is the margins on EVs versus margins on internal combustion engine vehicles. I mean, look no further than GM's results for just how, you know, much bigger margins are when it comes to those old school gas guzzlers. Just in 30 seconds, because I want to talk about some other stuff here, what's to watch for with that?
Yeah, I mean, ultimately, if you build vehicles at greater volumes, you can buffer the margins. And if you cut prices, that's clearly a headwind to margins. And Ford are trying to get that equation right. The Mach-E's unprofitable, but what they're saying is as we grow our footprint and produce greater volumes each year, there is some protection to margins that comes with that. I remember back in 2019, very quick, Jim Hackett, former CEO, the day they unveiled the Mach-E, Idris Elba was there, it was weird. He promised it would be profitable from unit one, but then the world changed. Right. You know, inflation, rising commodities costs.
Okay, this is what I wanted to talk to you about. It's a hard pivot. It's Palantir Technologies. Tomorrow, you've got a big interview with Alex Karp. He's the CEO and co-founder. 30 seconds. What's on your agenda?
Yeah, look, I'm getting a rare invite down to one of their facilities in Palo Alto. He's in town. Remember, this is a company that pivoted and moved from California to Colorado. And we're going to catch up, and you can catch the interview on Bloomberg Technology on Wednesday, 2 p.m. Pacific, 5 p.m. Eastern.
That's a great interview. Looking forward to it, Ed, and really appreciate you weighing in, as you always do for us when it comes to the EV space, because it's kind of fast and furious sometimes. Ed Ludlow, co-host of Bloomberg Technology at Bloomberg News, really wide-ranging conversation. I do think about these raw materials and precious materials, if you will, and the access to them, and it's kind of another race.
Yeah, and I think about a lot about how the technology's changed in just a few years.
For batteries?
For batteries, yeah.
Exactly. Ed there in our Bloomberg 960 studio in San Francisco. Catch him a little bit later at 5 p.m. on Bloomberg TV on Bloomberg Technology.
Let's get a check on the latest world and national news. Nancy Lyons in the 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. The one-year anniversary of the Russian invasion of Ukraine is coming up. It's February 24th, and Bloomberg's White House correspondent Anne-Marie Hordern says President Biden is confirming he will be making a trip to Poland to commemorate the date.
Today, when a reporter asked him about it, he said, yes, I will be going to Poland at some point, but he said the timing is still up for debate. So we're unclear yet if he will be making it around this time or potentially a little bit later in the year.
Again, Bloomberg's Anne-Marie Hordern. President Biden says money from the infrastructure law will go toward the Hudson Gateway Tunnel that will serve 200,000 Amtrak customers who travel from New Jersey into New York. He spoke during a visit to New York today.
The new tunnel, the president said, will enable rehabilitation of the one that's been in use since the year 1910 and was badly damaged by Hurricane Sandy.
This is one of the biggest and most consequential projects in the country, but it's going to take time. It's a multi-billion-dollar effort between the states and the federal government. But thanks to and I emphasize the bipartisan infrastructure law, we finally have the money and we're going to get it done. I promise you, we're going to get it done.
The president ticked off a list of other projects along the busiest U.S. rail corridor, the Northeast, which is served by 2,200 trains a day. In Washington, Irv Chapman, Bloomberg Radio.
Embattled Republican Congressman George Santos has informed his GOP colleagues he will not serve on his two assigned committees until the controversies surrounding him are resolved. House Speaker Kevin McCarthy says he'll leave the door open for his return.
The voters have elected him. He'll have a voice here in Congress, and until he answers all those questions, then at that time, he'll be able to be seated on committees.
McCarthy met with Santos last night. The freshman lawmaker has admitted to lying about everything from his religion to his education and work history. Global news powered by more than 2,700 journalists and analysts in over 120 countries.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We check the markets all day long at Bloomberg. Stocks are higher, and this update brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. It is time to take advantage of the newly extended Employee Retention Credit. Innovation Refunds has helped small and medium-sized businesses impacted by COVID-19 claim over $3 billion in refunds, and they're standing by to help your business get back the money it may be eligible to receive. Learn more at getrefunds.com. Stocks staying higher. We've just got minutes to go until we wrap up the trading month of January. Right now, the S&P is at 4,057, up 1%, a gain now of 40 points. Dow Industrials up 231. That's an advance of 0.7%. And NASDAQ up now by 136, higher by 1.2%. So the S&P 500 index wrapping up January with a gain of close to 6%. But will we see these gains continue? Victoria Fernandez is Chief Market Strategist at Crossmark Global Investments.
Don't hate the rally, but I don't think we're in a sustainable rally at this point. I just don't think that we have cycled through the things we need to, through the earnings, through the rest of the rate hikes, through the rate hikes that we've already had and their effects that are going through the economy. There's so many different elements out there that we still need to churn through before I think we can say we're in a sustainable rally, but use it to your advantage.
10-year yield right now, 3.51% with the 2-year, 4.19%. Gold up 0.2%, 19.27 the ounce. West Texas Intermediate crude up 1.5%, 79.07 a barrel. Lots of earnings after the close of trading today. Among those names, Advanced Micro Devices, shares higher now by just about 3%. We'll also be hearing from Juniper. That stock down 0.5%. Match Group up 3.1%, and Electronic Arts down by 0.2%. And that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 17 minutes left in today's trading session. We've got, as you heard from Charlie, a rally underway. We've seen yields back off a bit. This less than 24 hours away from the first Fed decision of the new year. And coming up, we have a good guest to talk about what's going on in the trade here.
Yeah, very pleased to have with us this afternoon Larry Pitkowski, Managing Partner and Portfolio Manager at Good Haven Capital Management, joining us on the phone from Millburn, New Jersey. Good to have you with us, Larry. So here we are at the end of the best January in years. We're seeing a rally just as the Fed kicks off its two-day policy meeting, with the S&P 500 up by a full percentage point. Does the Fed rain on the parade tomorrow?
Tim, it's nice to be here. Hello, Carol. Tim, I appreciate you starting with an easy question. Okay. And it's an easy question because I don't know. It is not the type of thing that we try and make short-term predictions about. And my I don't know is not a flippant or dismissive I don't know. It's a respectful and humble I don't know, because I do know, I believe, where at Good Haven our circle of competence as investors ends. And we try very hard to develop a variant perception about the handful of companies we have an investment in, and we try and make those investments where we think we have margin of safety. But I don't think we have the ability to have a variant perception about short-term moves in Fed policy, interest rates, and the GDP. So we understand what everybody seems to be kind of expecting, a quarter of a point and the beginning of some slowdown in this. And we don't have a very different view. And again, we're not dismissive.
I guess for me, it's more about commentary and less about a singular move tomorrow. It's more about what Jay Powell says about holding rates higher for longer and what he says about financial conditions.
Our view about the recent environment is the following. I am not as young as I look or sound. I have seen periods where there have been existential risks to the financial system and to the economy. I've been saying for the last...
So in other words, you understand that a zero interest rate environment is abnormal, not normal.
Carol, you make a great point. And a few years ago, we did say, like, look, interest rates will go higher at some point. And we tried to add some things to the portfolio that we thought would benefit from somewhat higher rates. There's some financial companies that could use more interest income, whether it be property and casualty insurance companies or some aspects of the commercial banking sector. But I don't think what we've been experiencing recently, which is much higher interest rates and a slower economy, is an existential economic risk compared to some things I have seen in my career. So we've been doing what we normally do. We get up earlier, go to sleep later, and keep looking for a handful of companies that we think can do fine even in a imperfect economy, and we've been fortunate enough, to be able to find some.
Well, and I'm looking at your fund, the Good Haven Fund, year to date up more than 7%, putting it in the 93rd percentile according to Bloomberg data. Longer term, 3 years on average, annually a gain of more than 11%, putting it in the 90th percentile. So you're making some good bets. A listener and viewer of Business Week writing in and saying, what went into the decision to invest more in larger cap stocks as opposed to small to mid cap stocks?
First of all, Carol, thank you for noticing. We have been working quite hard, to continue to drive long-term returns, like that for us and our fellow shareholders. So thank you.
You're welcome.
We have a mix of larger companies, some of them that are household names. We have a mix of some mid-sized companies, and we have some real below-the-radar screen companies. We are not, myself and also Artie Kwok here, who works with me, we are not waking up every day saying, boy, we want to look for another company of a certain size, or, we're looking for the best bargains in companies we feel that we understand where they are going, we understand the management teams, we think we have an edge in understanding the business and where we're buying with a margin of safety that we can find. And, one should find great things infrequently, but we've been fortunate to have been, I think, positioned reasonably well, as the statistics you called out have demonstrated.
What's been a new buy as of late?
Well,
and not necessarily a whole new position or adding to a position.
Well, we had kept our eye on for some years KKR. In our mind, the movement of capital to the alternative asset managers over the last bunch of years was a very interesting trend, and it was not a trend we thought was stopping anytime soon. As a matter of fact, very recently, I think New York has upped the percentage that they're going to commit to alternatives from like 25% to 35%. We ended up first, we looked at KKR and we admired what they had built. Distributable earnings had gone from like $1.66 in 2017 to recently like $4.50 a share. That's $1.66 per share to $4.50 a share over the last trailing 12 months. And we bought some at the peak of the COVID in the spring of 2020, when the world was going through a very difficult period. But we have added to it in 2022, kind of around these prices. What I think has been interesting lately is some of the cloud from some of the issues surrounding the Blackstone B-REIT, I think has given perhaps an opportunity to look at the whole sector. And KKR is the only one we own, and we think it's well managed. We think we understand where the business is going. We think earnings, management says they think earnings can be $7 within a couple of years, and we think that's intriguing.
Yeah, it rallied big time in 2020, 84% higher in 2021, down about 30, almost 38% last year. But we're seeing money move into KKR. Certainly this year, it's already up almost 20% here in 2023. Larry Pitkowski, thank you so much. Managing partner, portfolio manager at Good Haven Capital Management, joining us on the phone from Millburn, New Jersey.
All right, we're seeing this rally continue into the close. We're pretty close to session highs. The S&P 500 up more than 1%. The NASDAQ up 1.2%. The Dow, Carol, up about 0.8%.
Quick check on yields, because certainly waiting for that Fed decision. 10-year note with a yield of 3.51, shorter end of the yield curve. 2-year note yielding 4.19. Coming up, we're going to get to the markets in just a few minutes. This is Bloomberg.
company news headlines on Bloomberg Radio.
It is 3:53 on Wall Street. From Bloomberg World Headquarters, I'm Charlie Pellet. We begin with a developing story and a headline from the Bloomberg Professional Service. The event software company Cvent Holding is said to be exploring a sale that, according to the Wall Street Journal, shares of Cvent, they are surging on that report, up now by just about 14%. Caterpillar posted lower than expected quarterly profit for the first time since the start of the pandemic. And with more on the quarter out of Caterpillar, by the way, the stock down by 3.5%. Here's Bloomberg's Steve Rappaport.
Caterpillar posted lower than expected quarterly profit for the first time since the pandemic began, with adjusted earnings of $3.86 a share. The maker of iconic yellow bulldozers blamed rising raw material costs. That, coupled with supply chain issues, took a bite out of profit margins. Caterpillar repeatedly raised prices of its equipment to offset those challenges with great success. In New York, I'm Steve Rappaport, Bloomberg Radio.
And again, we've got shares of Caterpillar trading lower by about 3.5%. General Motors also reported this morning saying it expects its earnings momentum to grow this year on higher production volumes after reporting a better than expected profit in the last 3 months of 2022. General Motors shares, they are higher by 8.3%. ExxonMobil after earnings is trading higher by 2.2%. And McDonald's reported fourth quarter sales that exceeded expectations. McDonald's shares down today by 1.5%. Those are the company stories we're watching. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
You are listening to Bloomberg Business Week. Carol Messer along with Tim Stenevec, getting ready for some earnings to cross, including Snap. That'll come a little bit after the closing bell, but it'll give us an indication of what's going on when it comes to social media and particularly the advertising market. Having said that, I'm watching stocks buying into the close in these last few minutes.
I'm looking at the U.S. Financial Conditions Index here at Bloomberg, and it's down a little bit from yesterday, but conditions are as easy as they were, Carol. You have to go all the way back to, February to see financial conditions this easy.
Yeah, they've been really, really easy. And this is something that we do wonder, is this going to be on Fed's radar? And a little bit worried about, kind of easing off the rate increases earlier, rather than later. So this is something certainly we're thinking about. Interesting to see this buying, 1.5% higher on the NASDAQ right now.
Some real buying into the close happening right now.
You know what else is happening right now? Americans are leaving high-tax New York and moving to Florida.
Hold on. What year is this? Did we read this story last year?
Did we read this in the pandemic? Yeah. Low taxes, warm weather. Once again, a draw for Americans in 2022 last year, with Florida and Texas seeing the most migration from other states. This is according to a report from the National Association of Realtors.
On the flip side, California, New York, and Illinois are losing the most people. Americans have been leaving high-tax states for years, shifting to the Sun Belt in search of bigger houses, sunshine, and lower costs. The trend picked up steam during the pandemic and continued through last year, even as offices in major cities like Chicago, New York, and San Francisco reopened and bosses started calling employees back to the office.
And it's interesting. We've been talking about, what are the trends that kind of stick around with us post-pandemic? And I do think, I don't know, are all these people working, or some of them retiring? Like, what is it? Or they're working from home so they can live anywhere?
I think a lot of it, I think yes, and yes. I think a lot of it's, retirees. I also think a lot of people who have more flexible work environments can pull it off. And maybe some companies like Citadel, look at Citadel, they're moving people.
Big time. That was a big, big move for them. All right, in just a few minutes, as we said, we're going to head over to our TV colleagues, talk about the market close, talk about this rally that we have on Wall Street ahead of that first Fed meeting. 24 hours from now, folks, we will know the results of that Fed meeting. Highly expected to be another 25 basis point increase, but we'll also get that Fed commentary. Right now, though, it's time to check in with our TV team, talk about the markets, because Beyond the Bell, it starts right now.
Bell, full market coverage, as always, right here on Bloomberg Television as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. the end of January. Romaine Bostic here alongside Katie Greifeld. We're counting it down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Masser and Tim Stenovic. Welcome to our audiences across Bloomberg Television and radio, as well as to the folks joining us streaming on YouTube. Carol, a pretty strong finish to a month that I think a lot of people saw as a great relief rally. The question now is, does this persist beyond January?
Well, it's certainly persisting here in the last few minutes of trading. I'm kind of shocked to look at these charts here. S&P, Dow, NASDAQ, you're seeing buying into the close in these last few minutes of trading. I really was convinced that this was going to be a mellow day ahead of that Fed meeting tomorrow, Tim.
Well, I'm just wondering how Jay Powell and other members of the Federal Reserve Board are looking at, a rally like this. Not today, but just for the month, where the Dow's higher, the S&P 500 is higher by, close to 6%, the NASDAQ shooting higher. I mean, it's the best January in years, all at a time when, financial conditions are at a place where they were last February, before the Fed started hiking.
And it's not just the big benchmarks either. I mean, you have all sorts of risky assets rallying in January. Of course, I'm talking about Bitcoin. I'm also talking about CCC rated debt, the riskiest parts of the bond market, truly in everything rally.
Truly so. I mean, we were talking municipals a little bit earlier, 3% rally on the month, one of the best months we've seen there, I think, in at least a decade. And then you talk about some of the other asset classes, whether risky or safe. Yeah, it really was everything. The question is, do those correlations start to break apart? Do we go in a different direction? A lot of earnings on tap today, as well as for the rest of the week. The Dow Jones Industrial Average going to finish the day higher by more than 300 points, almost 400 points, up about 1% on the day. The S&P 500 up by almost 60 points, or 1.5%. The NASDAQ Composite up 190 points, or about 1.6% here on the day, while the Russell 2000, relative outperformer, up about 2.5%. All of the major indices higher on a monthly basis. The NASDAQ in the double digits, up about 11%.
Yeah, and as we pull up our earnings screen and wait for some earnings after the closing bell, I'm thinking about the earnings from those home builders once again that really pushed that group overall higher today, Katie. Overall, if you look at the S&P Composite, Home Builder Composite, up almost 5% in today's trade.
I'm thinking about the industry groups because there's 24 of them, and all 24 are in the green. Of course, as we count down to those earnings, to the Fed, you see what's up top. It's the autos following those GM earnings. You also have transportation and materials higher as well. You look down the list, there's not too much to pick at, but utilities, some of those consumer stocks at the bottom, Carol.
Yeah, I want to stay with the automakers because I agree. That was a group that really caught my attention when I was picking through and looking for some gainers today. GM, you mentioned it, Katie, up 8.3%. Certainly a standout in today's trade, and definitely saw that move higher, as well as Tesla, which was up about 4%. I know we have some earnings going through. Do we want to go to them, guys?
Well, let's go through a couple of them here real quick. Amgen crossing the wire. I will start there. Of course, ticker AMG, and company announcing basically their 4Q numbers. The adjusted EPS coming in at about $4.09. That's basically on the nose of what the street was looking for, which was $4.08. So a penny beat there. As far as the revenue numbers, a little bit lighter than what the street was looking for, $6.8 billion. Actually, I should say that's actually pretty much on the nose of what the street was looking for. So it looks like Amgen, guys, basically meeting the consensus expectations of the street, at least on the top and bottom line numbers.
All right, so Amgen coming across, and we're watching that one. Electronic Arts also coming out with a few headlines here. Fourth quarter net bookings, so we're looking at some outlook here. 1.68 to 1.78 billion. That seems like it is light because the estimate that's out on the street is 2.2 billion, 2.22 billion to be exact. Looking backwards, third quarter net bookings, 2.34 billion. That too was a bit of a miss, 2.44 billion. Interesting in terms of the gaming space and kind of an opener to some of the other numbers. That stock, Tim, it looks like it's bouncing around. It was down a bunch, down about 6%, unchanged. So we're seeing some volatility in the after hours.
All right. Well, I'm looking at the CFO statement here in the press release. Quote, as market uncertainty mounted during the quarter, this is for EA, we took measures to protect underlying profitability. The company's CFO, Chris Su, continuing, we are prioritizing the player experience, directing investment to where it can have the most positive impact for our players and on growth.
All right, I'm still taking a look at EI because you can see the stock really tanking after hours, down almost 7%. Yeah. This is a little bit interesting because you think about the expectations. Bank of America was actually out with a note yesterday saying that the expectations, the consensus rather, estimates for this company look too low in the quarter. So you see, you compare that to the numbers we're actually getting, it doesn't quite stack up.
It'll be interesting to see. We'll dig into that. Of course, we still are awaiting earnings out of Snap, AMD, a few other names here on this Tuesday afternoon, guys. But you go back to some of the performance that we saw in January, and more importantly, I know, Carol, you were about to go through some of the gainers on a daily basis, but I was taking a look at some of the big movers that we saw on a month-to-date basis, year-to-date, if you will. Of course, Tesla belongs in that group, up about 41% here. But also, I thought it was interesting. Yeah, Western Digital rallied 39%. We're going to get earnings out of them in just a few minutes as well. And then it was actually, well, a lot of the streaming services, the Paramounts and Warner Brothers of the world. In fact, Warner Brothers Discovery, a biggest gainer in the S&P 500 this month.
I mean, it's essentially companies that just got beat up last year, Romain. That's what's so interesting about this. I mean, do you think there's, back to Tesla, do you think there's anything fundamental about the Tesla rally? Because at the start of the year, at the end of last year, I mean, all we could talk about was how close Tesla was getting to $100 a share.
I think it remains to be seen here exactly what people are trying to price in with regards to that rally. I think you can make a case for some of the other names that they really were maybe kind of the baby thrown out with the bathwater, and a lot of people recognizing that at those valuations, maybe now was the time to get back in.
At some point, there's an entry point, right, for some investors. I'm just looking at...
And we should point out, Carol, that's different for everybody, right?
Absolutely, absolutely. But, you know, you look at some of the standout groups here. Consumer discretionary up almost 15% here in this first month. Communication services, this is a lot of the companies that are going to be reporting, these big tech names. They're up 14%. It really does feel like risk on trade. And Romain, that we're buying into this economy reopening.
Yeah, and just speaking of Western Digital, the earnings, we haven't quite gotten the earnings yet, but we are getting some news crossing the wire on them. And this actually has to do with an investment by a bunch of funds managed by Apollo. Western Digital actually saying that it's got a $900 million convertible preferred equity investment. This is led by the Apollo managed funds here. Interesting to see exactly where this goes here, because the conversion price is at $47.75. The shares today closed at around $42. So interesting to see why they're doing this here. Their numbers now crossing the wire for the quarterly report, and they're looking at an adjusted loss per share of about 42 cents a share. The street was looking for a loss of 12 cents a share. So this is a pretty big miss here on the adjusted loss per share. As far as net revenue, that came in slightly higher than estimate at about $3.1 billion. The street was looking on average for about 3 even. Your forecast going forward, 3Q revenue, a range of 2.6 to 2.8. That is lighter, lighter than what the street was looking for, which was about 3.1. So a big mixed bag here for Western Digital, guys. It appears to be providing guidance below what the street was looking for, and an interesting convertible investment being led by Apollo that could be dilutive to some existing shareholders.
Yeah, shares down 6% in the after hours. I'm looking at what the company's CEO says in the press release. He said that we're continuing to take action to reset the business in response to post-pandemic environment by optimizing our cost structure and strengthening our liquidity. He said they're strategically reducing CapEx across both Flash and HDD and our operating expenses, as well as amending our financial covenants and securing recent financing. That'll give them the flexibility and optionality to weather this cycle, Katie.
And we also have some earnings crossing from Mondelez, of course. It looks like the fourth quarter adjusted EPS beat the estimates. We're talking about 73 cents there. The estimate there had been for 70 cents. So that's the good news. So you look at fourth quarter adjusted margin, it's a little bit light. We're talking 36%. The estimate had been for 36.7%. You look at the after hours share reaction, pretty much unchanged as we sort through these numbers here. We had been expecting price increases to maybe offset some falling volume. Maybe that would be good for margins. Didn't quite pan out.
Yeah, I'm looking at the press release here coming from the CEO, of course, Dirk Van de Put, and he talked about we also continue to deliver strong marketplace execution and amid challenging operating conditions and continued macroeconomic volatility. Talked about strength in emerging and developed markets, as well as solid contributions from their recently acquired businesses. So getting a little bit of an outlook, looking for a little bit more on costs here.
Yeah, what I'm really interested to hear from the company when they do their earnings call is the pricing power that they have and what they're seeing from consumers across their portfolio of different snacks. If they're seeing them trade down, if they're seeing prices have to increase, if that's hitting consumers and consumers are deciding to spend their money elsewhere, Romain.
And I think it's interesting because we've seen a few of the other consumer staples companies report already, pretty much the ones in the food space here. And it has been a sort of a story of that pricing power finally starting to wane. We heard that, of course, out of P&G, Kimberly-Clark, and a few other companies here. Interesting to see what the commentary will be on that call out of Mondelez.
And it comes to this question of how does a company protect margins then? You have to cut costs, and that leads to all the layoffs, all the other cost-cutting measures that we have seen, but it seems like the consensus
And how much room do they have?
Exactly.
Though? I mean, we talk about the tech companies being bloated. You can't really make that case that a company like Mondelez was ever bloated.
For sure. I mean, that gets back to the expectation that you're going to have to see more compression in those margins.
Yeah, go ahead, please.
But what's the end result of that? I mean, what's the end result?
Well, you would expect stocks to go lower, and that hasn't happened so far. Maybe, it's priced in already. You could make that case, but quite a rally that we just lived through in January.
It's exactly what David Costin said earlier, the clip that Carol played. I mean, the concern about margins moving
On
forward.
that point, Western Digital saying that it's a gross margin for the third quarter, its fiscal third quarter is going to be at 9% to 11%. That's down from an estimate of 20%. So that's a pretty big variance based on what the street was expecting and what the company is guiding to.
That's why it's important. That stock down about 6.7%. Amgen down just a hair in the aftermarket. And you've got Mondelez down about 1.4% as we await for those Snap earnings. All right, guys, that is a wrap.
AMD.
Oh, yeah, sorry. Thank you. Thank you for that. All right, so a few more earnings still to come. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, and, of course, on Bloomberg Quick Take, Beyond the Bell. We will see you again, same time, same place tomorrow.
But then he drops a bomb. Son, what do you do? I'm out of work. I need a job. I'm out of work. I'm unemployed. I'm out of work.
All right, everybody, amid all the layoffs, especially in the tech space, this opinion column by Bloomberg News caught our attention. It's about how the 8,000 or so layoffs announced so far don't exactly scream family values, do they?
They don't. Do I have to turn my microphone?
Yeah, it gets a little crazy.
On, Carol? Does that happen?
Yeah, it's good.
Well, that's the opinion of Bloomberg Opinion and senior columnist Beth Coet, who's with us via Zoom in New York City. Beth, good afternoon. Or should I say Ohana? How are you?
I'm well. Thanks so much for having me.
Well, the reason I use the term Ohana, well, actually, I think you should explain it. It's anyone who's followed Salesforce or followed, what its company's CEO, Mark Benioff, formerly co-CEO, has said about the company, the environment in his books. He's used the word Ohana a lot, and that's kind of the thesis for your opinion piece. Take us into it.
Yeah, that's right. So Mark Benioff is really known for I would say falling into this trope of calling his company family. So Ohana is the Hawaiian word for family support system, and so he often refers to the company as one Ohana. And my argument is that it's kind of harder to make that case when you're laying off 8,000 members of your staff.
Hey, hang on for just a minute because we are talking about tech and we just got a big company in the tech space that we've been awaiting reporting earnings. We're talking about Snap, which is down about 10 or 11% in the after hours. I guess one of the big numbers, fourth quarter revenue, a slight miss, 1.3 billion versus 1.31. Talking about the first quarter revenue as well. Internal forecast assumes first quarter revenue down 10% to down 2% year over year. Fourth quarter adjusted EPS, 14 cents. That's 3 pennies better than what the street was expecting. But daily active users for the fourth quarter, 375 million. That's a little bit better, Tim, than what the street was expecting.
Yeah, it's 12% year over year annual revenue growth for the company as well. Positive full year free cash flow. Evan Spiegel, the company's CEO, saying in a statement, quote, "We continue to face significant headwinds as we look to accelerate revenue growth, and we are making progress driving improved return on investment for advertisers and innovating to deepen the engagement of our community." In other words, the ad market continues to be a challenge.
So bottom line, stock down now 14%. So Snap forecasting its first ever quarterly revenue decline, citing a flurry of changes to its advertising products that may be disruptive to the social media apps business. This is a bit of a window opener before we get to the likes of Meta and some other big names in the social space.
Well, speaking of Meta platforms, down 1.5%, bouncing around in the after hours here in the wake of what we saw from Snap just now, Carol.
Yeah, and Snap's been on a bit of a rally this year, up 29% in the regular trade, but you're going to see a big haircut tomorrow when it resumes trading in the regular trade. Beth, forgive us. We are in the midst of earnings season. We'll see what Snap has to say about its staff going forward, but we are talking about a lot of layoffs within, it seems, or at least feels that way, when it comes to a lot of Silicon Valley companies. We were talking about, that they put out there a culture, and they're not alone in this. A lot of corporate America is like, it's a family, especially coming off the pandemic. We care about you and all those good things. Until maybe we don't make our numbers or the economy slows down, and then it's a little bit of a different story. So how do you make sense of it, especially? And I know you really dig deep into kind of Salesforce and their culture, and yet they let go of workers.
Yeah, I think that we see this very broadly in the tech sector. I think it's a strategy that a lot of these companies use for retaining and attracting employees, saying, look at our culture. we're a family. We want this commitment from you. We're going to give this commitment back. And I think it's a dangerous place to play when the boom times are over, which is what we're seeing now. And I do think the pandemic has played a big part in this. I think employees are saying that they want a little more separation between their family life and their work life. And I think this family culture sort of undermines that a little bit too.
It's interesting because it's kind of in stark contrast to the culture that Reed Hastings built over at Netflix, which is like, hey, we are not your family. We're like a professional sports team, and we're going to cut the players who aren't the best ones on the team. And for years, that culture got a lot of attention, Beth, because it was looked at as kind of one of the reasons for Netflix's success in pivoting from a DVD by mail order business to a streaming business, and the last couple of years notwithstanding. What do you make of that variation there?
I think we're going to see more companies moving in that direction. I think employees get it. I think they're wary of the family language, and maybe they appreciate being treated a little bit more like grown-ups. They understand that this is the way the business world works. We're not tech companies aren't these 5-person, employee companies anymore working out of someone's garage. I think it's hard to sell that family rhetoric when some of these companies are the biggest employers in the U.S., some of the biggest companies in the U.S.
I do wonder, I think bottom line, it's like Tim and I talk about this too. I feel like when it comes to ESG or environmental concerns, climate concerns, that, bottom line, until there's metric where you get measured, I guess there are outside organizations, right? There's Glassdoor, there's other things that say, is this a good company to work for? Is it not? And that's certainly, but unless there is kind of a financial benefit to being good, ultimately, as a company, that your culture matters and there's a financial factor to it or cost to it, it's kind of hard. Like, I get it. If you're a publicly held company, right? Beth, you've got to kind of think about how things are impacting the bottom line. We've had people on Twitter kind of send to us when we're talking about job cuts. They're like, well, isn't that what a CEO of a publicly held company has to do?
Yeah, I think in this case, in the case of Salesforce, what was particularly jarring for employees was, Mark Benioff sends out an email announcing the cuts, and within the same message says, these are our family members, check in on them. So I think that contrast was a bit jarring. But I think it's important to be clear here that you kind of creating this culture, using this language, is a business decision, right? Like there are reasons companies do it. It's about retention. It's about retaining employees. But I think a generation of workers tech workers has not really experienced the mass layoffs we're seeing right now, and that it's really calling into question how real this is.
Yeah, absolutely. Hey, Beth, we're going to have to come back to you at another time and pick this up, because I think it's a really important question of our time, to be quite honest. Beth Kowit, she is senior columnist at Bloomberg Opinion, joining us via Zoom from New York City. Folks, we did want to get to some earnings that are crossing, because AMD just coming out. The team is weighing, that's the Biden headline earlier. AMD seeing 2023 client and gaming segments down year over year. As for the outlook, sees first quarter revenue $5 to $5.6 billion. The estimate out there is $5.56 billion. So it sounds like it's reining that in a little bit. And first quarter adjusted gross margin 50%. The estimate was for 51.5%. If I take a quick check at AMD, though, it is up about 3.94% here in the after hours.
Linda Su, the company's chair and CEO, saying that although the demand environment is mixed, we are confident in our ability to gain market share in 2023 and deliver long-term growth based on our differentiated product portfolio. She also did note that 2022 was a strong year for AMD. The company accelerated its data center momentum and closed its strategic acquisition of Xilinx.
Meantime, we've got shares of Snap still down about 15%. Man, they are just dropping like a rock. This, as the company is forecasting its first ever quarterly revenue decline, citing a flurry of changes to Snapchat's advertising products that may be disruptive to the social media apps business. Projected revenue to drop 2 to 10% in the first quarter from a year earlier.
And shares of Meta Platforms in the after hours down a little over 2% right now. Again, these calls haven't happened yet. We'll wait to hear from the calls from the CEOs, and we'll see what the stock does during that time.
Match Group also down about 9% following its earnings. We'll have more details in just a moment right here on Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg Earnings, front and center after ours. We begin with Advanced Micro Devices, and its report came in better than feared. AMD is the second largest maker of computer processors. Its forecast for the first quarter has sent shares up after ours by about 4%. Gains in the lucrative server market help make up for a collapse in demand for PC chips, but after ours, AMD up now by just about 4%. Snap, though, heading the other direction. Snap shares down now by about 15%. Snap is forecasting its first ever quarterly revenue decline, citing a flurry of changes to Snapchat's advertising products. Match Group provided a forecast for first quarter sales that missed analyst estimates. After ours, we have got Match down by about 9%. And Electronic Arts, the video game publisher, out with earnings. After ours, Electronic Arts down by about 6%. Stocks ended January with a gain. As a matter of fact, we saw a rally in the final 20 minutes of trading or so, right into the close, sending stocks even higher. We wrap up January with the S&P at 4,076, up today by 1.5%. The Dow today up 368, up by 1.9%, and 1.1% on the Dow. NASDAQ was up 190, a gain of 1.7%. Now, this was a broad-based rally today. Russell 2000 surged by 2.45%. 10-year yield 3.49%. Spot gold up 0.3%. 19.28 the ounce, and West Texas Intermediate crude up 1.5%. 79.08 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening to Bloomberg Business Week. Carol Master along with Tim Stenovic live in our Bloomberg Interactive Broker studio. We're watching shares of Snap, Tim. They are down about 13-14% here in the aftermarket.
Yeah, the company forecasting its first ever quarterly revenue decline, citing a flurry of changes to Snapchat's advertising products that may be disruptive to the social media's app business. Those words by our next guest, Alex Barinka, Bloomberg technology reporter. She joins us right now in the Bloomberg Interactive Broker studio here in New York. Alex, I know you're super busy with earnings, so thanks for taking some time to do this. What are these advertising products that may be disruptive to Snap's business?
Yeah, we're hoping to bring you the good stuff here. This was actually buried down in the investor letter at the very end with a little bit of a forecast of what to expect for this year. Snap has really been trying to convince advertisers to spend more money, and a really important place for advertisers to spend money right now is what we call direct response ads. These are ads that people see and take an immediate action, like they buy something or they sign up for an email. It's also the piece of the business that, if you've been following the social media industry, Apple really threw a big wrench in when they changed their privacy policies and kind of hit revenue across the board for Snap, Meta, and others. So it sounds like they're coming in and making a lot of changes to try to improve these ads, these really important ads for marketers at the beginning of the year, and kind of taking the hit now. In this investor letter, they also said that long term, they think that this will make ads more effective. It'll bring more success for marketers. But if you're an investor and you're looking at this, it's a pretty painful hit here for Q1.
So there's kind of the Snap specificity when it comes to social ads, and then there's the global macro environment when it comes to ads. I mean, great if they're making changes, maybe it'll work, but they've also got to deal with an environment that could be slowing down.
And they are a little bit connected. When the environment's slowing down, marketers want to pay for ads that they can see the results.
Right.
So these kind of direct response ads are really important. Snap also does like brand awareness where you're telling stories. Those types of advertisements in the fourth quarter actually fell double-digit percentage, whereas these direct response ads in the fourth quarter were up 4%. So just to kind of put in context for this company how important these changes will be, makes some sense here that they are warning investors that they might see revenue fall 2 to 10% in the first quarter from a year earlier, and they've already seen a revenue decline of about 7% so far in January in Q1.
It's a lot, sounds like.
Shares of Meta platforms down 1.5%, Alex. It seems to me, based on what you're saying, that this is more of a Snap-specific story than it is an industry-wide story. I mean, we knew there was weakness in online advertising. Snap told us that a year ago, and we saw a big reaction in peer stocks like Pinterest and more. But is this bigger than just Snap?
So I will actually look to last year and say it might be. Snap was kind of a bellwether last year. They were the first one to say, hey, look, macro conditions are bad. They were the first one to cut workforce. They were the first one to kind of refocus their business, and then Meta followed suit. So Snap seems to be a couple quarters ahead. We do think that the macro environment will still impact Meta. We're predicting, analysts are estimating another decline in sales for Meta to the tune of 6% when they report tomorrow. So we'll be watching that revenue number really closely. So I think it's a mix of both. Meta also has had the same issue with these direct response ads that they've been trying to fix by changing their algorithm. So we'll definitely be looking to Meta CEO Mark Zuckerberg tomorrow for color on how they are navigating these choppy economic waters and convincing marketers to open their pocketbooks on things like Facebook and Instagram.
Alex, what's more desirable for advertisers, or for a company that's got a brand? Is it Meta? Is it Snap? What is it?
It's whoever can show that the dollars they're spending is getting them the results they need the clearest.
So they want to see the data. And
they want to see data. They want to see certainty in uncertain economic conditions. If they need to spend to acquire customers, they want to be sure that every dollar they're spending is worth it.
Sounds like what venture capitalists want to do. So we're going to get into that in just a moment. So much appreciation, Alex. Thank you so much. For Bloomberg Technology reporter Alex Barinka breaking down Snap earnings. The stock's still down about 14% in the aftermarket. And Tim's been rightfully bringing up Meta, which reports tomorrow. It is down about 2% here in the after hours.
Yeah, shares of Pinterest down at 2% in the after hours as well.
All right. Well, speaking of getting value, venture capitalists, they know that they've sometimes got to plow money into a company for many years before they start to find some value or value creation. Having said that, we kind of wanted to take a look at the world of VCs and the startup world, and we've got a good guest to do that.
Jeff Grabo is U.S. venture capital leader at the consulting firm EY. He's with us via Zoom from Palo Alto, California. Jeff, good to have you with us this afternoon. The companies that we were talking about all began as startups, and as Carol mentioned, we recently did talk about the challenges that are facing startups right now that are out there trying to get cash. What are you seeing in the current environment when it comes to venture capital right now?
Well, 2022 was a very interesting year. After an unprecedented run, the market flipped from being a seller's market to being a buyer's market. Even though 2022 was the second highest year of venture-backed startup activity, every quarter we saw the amount of money going into venture-backed startups decrease. And a primary reason was and has been the decrease of the $100 million mega round financings that were ever so common in 2021. The bar continues to go up on companies that can raise money. Hot deals are still getting done, but not all deals are as hot as they once were.
So is it a smarter market now, Jeff, and much more discreet, if you will, or, very kind of picky in terms of where it should go? And maybe that's right. Maybe what was happening in 2021 was a little bit loose and maybe not as smart.
Well, if you take a macro step back, the past 6-7 years we've seen incredible growth in the venture market. Massive amounts of capital have been going in. 5 of the last 6 years were record investment years. So not all, you can't have a bull run forever without getting tired. Not all bull markets last. Nothing goes up and to the right forever. The venture business is a marathon. The venture and startup business is a marathon, not a sprint. And in reality, we've been sprinting for a while. And so it's probably healthy to kind of pull back and digest and have a pause.
What are the types of companies that are getting money right now?
Well, it's interesting. All sectors were down, IT, healthcare, consumer. It's hard to fund a consumer company looking into a potential recession. That makes it more challenging. But one sector that was up this year was energy and utilities. And that's being driven by the climate crisis, climate change, et cetera. And technology is being pushed into helping solve some of those problems. So it was actually up about 17% this year. And so even though it's the fifth sector, fifth place from a sector perspective, I think it's one that we should watch.
It's interesting too, and I wonder as I hear you speak, what's been the impact of Microsoft's $10 billion investment into ChatGPT? Are people kind of all of a sudden, wait a minute, how do I get a piece of that?
Well, it's interesting. I think that you look at generative AI and some of the things that can come off of a platform where you've got artificial intelligence operating at a very high level. presents a lot of opportunities. And that kind of gets back to things aren't all gloom and doom. I fully expect to see some fantastic companies that get started in the next year or two. Investors are out there looking for it. There is a record amount of dry capital on the sidelines. We've never had more capital available. It's just it's being deployed at a different pace.
So what does 2023 look like if the Fed keeps rates high, which it likely will, or told us it will?
Yeah, I mean, there is a record amount of capital available, as I just mentioned. I expect the first couple quarters to be slow and slower, and I expect probably 2022 to come in under the $200 billion mark. We were about 209, I think, this year. I think it'll come in under 200 billion. But even if it's down further than that, it's going to be a top 2-3 performing year. So we're still in very rarefied air.
All right, going to wrap it on that. Hey, Jeff, thank you so much. Jeff Grabo, he is U.S. Venture Capital Leader at EY, joining us via Zoom from Palo Alto, California, and watching some of the names in the aftermarket really take a bit of a beating. Match is down about 8.5%. Following its latest earnings update. It's forecasting sales will miss analyst estimates. We just talked about Snap. It continues to be down about 13-14% in the aftermarket, about its outlook, which was disappointing, Tim.
Yeah, revenue for Snap projected to drop 2 to 10% in the first quarter from a year earlier, the company said in a statement. We're going to continue to watch these companies and bring you updates as they happen. In the meantime, let's get to world and national news with Nancy Lyons in D.C. Hey, Nance.
Thanks, Tim. President Biden will be meeting with House Speaker Kevin McCarthy tomorrow to discuss a deal on raising the debt ceiling. Republicans are asking for spending cuts before any increase in the debt limit. Senate Republican leader Mitch McConnell says McCarthy does have the support of his party.
We're all behind Kevin and wishing him well in the negotiation.
McConnell also says he agrees with the decision made by Republican Congressman George Santos to recuse himself from his 2 assigned committees until he can clear up some of the controversies surrounding his resume and finances. Well, President Biden is taking a victory lap. He traveled to New York today, where he touted the success of the bipartisan infrastructure law that's providing money for work to begin on the Gateway Tunnel project connecting New Jersey with Manhattan.
This tunnel opened for business in 1910. 113 years ago, and the structure is literally deteriorated. The roof is leaking, the floor is sinking. Plus, it was badly damaged by Superstorm Sandy. I was the vice president. I came and walked through this tunnel.
Biden says the new tunnel will be critical to easing congestion on one of the major bottlenecks on Amtrak's Northeast Corridor. Well, as expected, today a New Mexico prosecutor filed criminal charges of involuntary manslaughter against actor Alec Baldwin in the shooting death of cinematographer Helena Hutchins. A weapons specialist was also charged. In a bid to reverse the first drop in birth rates in 6 decades, China's southwest province of Sichuan will now allow unmarried people to have children. The new rules will allow single parents to now receive benefits that were only reserved for married couples. Sichuan is the 3rd province to adopt the new policy. And in the U.S., as a contrast, for the first time after 6 years of declines, the number of births in the U.S. has increased by 1%. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It is 4:41 on Wall Street. I'm Charlie Pellet. Big rally into the close. We check the markets all day long at Bloomberg, and this update is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. If your business was hurt by COVID, it may qualify for a payroll tax refund. Even if you took PPP, your business may still be able to claim the Employment Retention Credit. See if your business qualifies for ERC assistance at getrefunds.com. S&P today up 58, a gain of 1.5%. The Dow today up 368, a gain there of 1.1%. NASDAQ up 190, a gain there of 1.7%. A lot of the rally coming in the final 30 minutes of trading or so. A lot of buying into the close. 10-year yield 3.50% with a 2-year 4.20%. So an update for Wall Street as we close the books on January. It is on to the trading month of February, and Caterina Simonetti, Senior VP at Morgan Stanley, told us the enthusiasm may be overdone.
This optimism is highly premature. We think that there is a lot more volatility ahead, and in our view, the story for 23 is not the story of the Fed or inflation or even the fact that CPI is getting under control, which of course is good news. This is the story about the earnings, and specifically earnings revision.
And we've got lots of earnings stories for you. AMD, second largest maker of computer processors, out with a better than feared sales forecast. After ours, AMD up by 3.8%. Snap plunging 12.5%. It is forecasting its first ever quarterly revenue decline. Also out after the closing bell, Match Group, that is the dating app conglomerate, it provided a forecast for first quarter sales that miss analysts' estimates. Not a match there, down by 9%. Again, recapping stocks higher today. The Dow, the S&P, and NASDAQ all advancing. S&P up 1.5%. Russell 2000 cannot ignore that, up 2.5%. And spot gold today up 0.3%, $19.28 the ounce. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Well, our next guest has a dire warning. He writes that we are at a, quote, inflection point. The two basic components of the democratic capitalist system are at risk of splitting apart. This poses an existential threat to human progress in the 21st century, paralleling the importance of climate change. This is how this new book that is out begins.
The book, Invisible Trillions, How Financial Secrecy is Imperiling Capitalism and Democracy, and the Way to Renew Our Broken System. The author, Raymond Baker, is founder and president of Global Financial Integrity. It's a think tank based in Washington, D.C. that focuses on illicit financial flows, corruption, illicit trade, and money laundering. Good to have you with us this afternoon. Congratulations on the book, Raymond. I wanted to start with the title, the subtitle here, Financial Secrecy. How do you define financial secrecy?
It's a series of mechanisms that work together to allow capitalism to operate in secrecy. Tax havens, secrecy jurisdictions, disguised corporations, anonymous trust accounts, fake foundations, falsified trade that is conducted where invoice values and real values do not match. And then there are all sorts of money laundering techniques that are used to handle particular kinds of transactions. And then, to be honest, another part of the system is holds that governments leave in the laws of their countries that facilitate the movement of money through this financial secrecy system and ultimately into their own economies. The U.S. is the recipient of more illicit money, more dirty money than any other country.
So, Raymond, one thing, is it the case of as long as there's money and there are some people who have more money than others, that this is just going to be a problem? This is just the way capitalism works?
Interesting question. This is not the way that capitalism worked at the turn of the century. At mid-century, at the mid-20th century. There was a 15-year period in there between the end of World War II and 1960 when capitalism operated at a very high level of responsibility. In fact, at that time, the ratio of income for the executive class and the workers class, the ratio at that time, let's take 1960, was only 20-1. Today, that ratio is more than 350-1. And the reason it has exploded is because we have set up so many mechanisms that enable money to move in hidden ways, in disguised ways, and it therefore inevitably moves to the top.
So who's responsible for creating this system?
We are. A lot of people think...
What do you mean by we, though? I mean, is it...
We in the wealthier Western countries. A lot of people think that this is something that has been done to us by drug dealers and traffickers and counterfeiters and terrorist financiers and so forth. That's just not correct. We in the richer Western countries have created every single technique, every single element of the financial secrecy system that is today used to move trillions and trillions of dollars around the world.
So, you know, it's interesting. I feel like you can see the whiteboard in the cycle, right? You know, individuals, companies make money, and they ultimately then have the power to support political candidates and initiatives that lead to whether it's tax breaks or policies that benefit them. And, you know, politicians listen because that gets them elected, it gives them money to run campaigns that are expensive. And so the cycle continues. Is that the basic cycle that's the problem, or is it something more or different?
You've hit it right. You've hit it right. You've hit the nail right on the head. That's exactly what happens. The wealthy are able to buy the kinds of laws that perpetuate the financial secrecy system. Just to give you one example, I mentioned tax havens. There isn't a single tax haven that figured out themselves. I'm talking about the Cayman Islands and Guernsey and Jersey and other tax havens. There isn't a single one of them that figured out how to be a tax haven. No. We, from the richer Western countries, came to them and said, please adopt these kinds of laws, and then we will shift a lot of business through the tax havens. I repeat what I said. Every single element of the financial secrecy system has been created by us. Not a single piece of it was created by others.
So does that mean we can fix it?
Exactly. Since we created this, we can decreate it. And I think that's what has to be done in the capitalist system going forward. We have to decreate this financial secrecy system that is driving crime and corruption and kleptocracy and even terrorist financing and authoritarianism, and worst of all, economic inequality.
Raymond, I have to jump in because we're running out of time. Just got about 35, 40 seconds. How do we do it? Because this is not a new issue. We've talked about it a lot here at Bloomberg, and I think it's great that you are, you know, drawing more attention to it. But it's not a new necessarily idea. We kind of understand it. So, what one step could we take that would change it dramatically? And just quickly.
The broad answer is increased transparency and accountability. Let me just give you one example of that. There are millions of disguised corporations around the world. Get rid of disguised corporations. Get rid of shell corporations. And that can be done with a simple law that says it's illegal for banks to receive money from shell companies. We did exactly that with shell banks. There used to be one of the elements of the financial secrecy system was shell banks. We took shell banks off the table just like that. Well, we can do the same thing with shell companies if we choose to do so.
No, it all makes, I think a lot of people are probably listening saying, yep, I get it, it makes sense. Raymond Baker, thank you. Founder and president of Global Financial Integrity. His new book, Invisible Trillions, How Financial Secrecy is Imperiling Capitalism and Democracy and the Way to Renew our broken system. Joining us there from D.C., this is Bloomberg.
Your company news headlines on Bloomberg Radio.
And good afternoon, 4:53 on Wall Street. I'm Charlie Pellet at Bloomberg World Headquarters. Advanced Micro Devices shares up now by 2.1%. AMD's the second largest maker of computer processors, and it gave a better-than-feared sales forecast for the first quarter. Snap, though, plunging 14%. It's forecasting its first-ever quarterly revenue decline, citing a flurry of changes to Snapchat's advertising products that may be disruptive to the social media apps business. Match Group down 8% after hours. It provided a forecast for first quarter sales that missed analyst estimates as it looks to cut costs, extending the pain of a year where the dating app conglomerate shares sank amid management upheaval. United Airlines is joining forces with an ethanol maker in a bid to ramp up production of green jet fuel. And with that story, here's Bloomberg's Steve Rappaport.
United Airlines, biofuels producer Green Plains, and infrastructure firm Tallgrass Energy Partners are jointly investing up to $50 million for a venture to avert climate change. Blue Blade Energy has a goal to bring to market technology to simplify making sustainable fuel using ethanol and other alcohol-based ingredients. United plans to buy as many as 2.7 billion gallons of the environmentally friendly fuel as the airline works to reach net zero emissions by 2050. United Ventures President Michael Leskinen says the initial investment is for testing development. In New York, I'm Steve Rappaport, Bloomberg Radio.
And today we saw UAL shares up by just about 1.6%. After earnings today, General Motors rallied 8.4%, and those are our company stories. I'm Charlie Pellet. This is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week. Let's get a check on the latest world and national news with Dan Schwartzman in the 1130 newsroom in New York. Hey, Dan.
Hey, thanks, Tim. Embattled Republican Representative George Santos informing his GOP colleagues he will not serve on the two committees he has been assigned to until the controversies surrounding him are resolved. Santos has admitted to lying about everything from his, religion to his education and work history, while also being under investigation for his finances. House Speaker Kevin McCarthy, though, has left the door open for Santos to return to the committees.
The voters have elected him. He'll have a voice here in Congress, and until he answers all those questions, then at that time, he'll be able to be seated on committees.
McCarthy met with Santos Monday evening. The freshman rep was slated to serve on the Committee on Science, Space, and Technology and the Committee on Small Business. As House Republicans look for ways to rein in government spending, at least one prominent member says the defense budget should not be immune to cuts. Bloomberg's Nathan Hager reports from Washington.
Ken Calvert is the new chairman of the House Appropriations Defense Subcommittee. He tells Bloomberg Government the Pentagon's $817 billion budget should grow 3 to 5% over inflation, but he also wants to look at how the Defense Department operates. Calvert says he'll focus on the Pentagon's payroll and inventory, how it buys weapons, and how to reduce its civilian workforce, mostly through attrition. In Calvert's words, when it comes to defense spending, there's a lot of low-hanging fruit out there. In Washington, I'm Nathan Hager, Bloomberg Radio.
Inflation and COVID lockdowns didn't have any effect on Las Vegas gamblers as casinos won a record total of $8.29 billion for 2022, a 17% increase from the previous year. Total visitors to Vegas also increasing significantly as the Strip saw 21% or 38.8 million more people than the year before. The number of trade shows and conventions, though, did not come back to pre-pandemic levels. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg. Carol and Tim.
All right, Dan, thank you so much. Carol Massar, Tim Stenevec, live in our Bloomberg Interactive Brokers studio, streaming on YouTube and on Bloomberg Quick Take. And all right, watching earnings, watching
I'm waiting
Snap.
for tomorrow. Bed tomorrow.
Hold your horses, buddy.
Okay,
Slow
yeah,
your
we got
roll.
we got a lot before that happens. Okay.
Snap's down about 13% here in the after hours, so continuing to trade lower. The big news is we talked with our Alex Barinka, has to do with that forecast for first quarterly revenue, a decline, and so a disappointment. But it's trying to shift and trying to figure this out in terms of catching the advertising market where it needs to be and catching the eyeballs that advertisers want.
Right. We asked her if it's a Snap-specific story or it's something bigger. She reminded us that about a year ago we heard from Snap. It was the bellwether for the industry. They laid off employees before Meta ended up laying off employees. Shares of Meta, by the way, down 1.3%. We hear from the company after the bell. Tomorrow, shares of Pinterest in the after hours down by 1.8%.
Match is also slumping in the after hours. That stock's down about 7.6%. This is after the company came out and forecast for the first quarter that sales will miss analyst estimates as it looks to cut costs, extending the pain of a year where the dating app conglomerate shares sank amid management upheaval. So there's a lot of stuff going on with that one. And then you have AMD. This is an important one, right? The chip space. We've been watching it. Chips go into everything, and so you don't necessarily get the same thing from all of the chip players. They are different types of companies. AMD, though, it is up about 2.7% in the aftermarket. That is after Tim giving a robust forecast, helped by gains in the server market.
Yeah, the way our own Ian King describes it in his write-up of the results is better than feared. And when you say better than feared,